Welcome to another edition of Money Ideas. Here are 4 charts that change the way I think about global markets and could be the next opportunity for you. We start off with Venezuela's shadow reserve of $60 billion in Bitcoin. Now, if that is true, then it would make it one of the biggest holders of Bitcoin. A report is circulating that suggests that there is about 600,000 Bitcoin that could be attributed to Venezuelan ownership, and that will put it in the same league as MicroStrategy and quite far off from the US government. It is a significant amount. This matters to crypto markets for several reasons, and we're going to run through them together. And you don't want to miss out on that. So first is the scale. Human Intelligence is reporting that the amount of Bitcoin involved has been accumulated since 2018. Then you have the geopolitical dimension. The United States does not control these assets yet. And for context, it's about 12 times the size of the German Bitcoin sale that knocked markets down about 15% in 2024. And in terms of potential outcomes from all of this, there are several ways this could play out. The first would be you get tied up in some kind of legal uncertainty, right? Years of litigation effectively locking out 3% of total Bitcoin supply. And that will be a material reduction in the total float. Another scenario that I've read is the US treats any seized Bitcoin as a strategic reserve asset, something that is not auctioned off. Again, none of this I've been able to independently verify. And the less likely scenario is some kind of fire sale. And ultimately, what all of this plays into is not just a heightened level of global uncertainty, but potentially a new set of directional momentum for cryptocurrencies and Bitcoin. Have you been buying silver lately? Well, if you would have listened to our recent guest, Ryan Lamand, he just 2 weeks ago recommended to buy even more silver. His call was that it would break $100 an ounce. And that takes me to this other critical chart, the Silver-to-Dow Ratio. Basically, it tracks how many ounces of silver it takes to buy the Dow Jones Industrial Average. And history is revealing. In past cycles, most notably in the 1970s and again in the 2010s, silver didn't just rise, it reverted towards historical averages, and it did so violently. And those were periods where real rates were negative. You had currencies under pressure, and trust in the financial system was waning. And today, we're once again in a world where you've got a lot higher debt, persistent fiscal deficits. Central banks are trying to engineer a soft landing, and they don't really have a lot of room for error. And so silver sits at this intersection between money and industry. So what are some of the applications that require silver? Well, you've got solar panels, electrification, data centers, sort of defense. And then you look at the supply side, which has been flat to declining for years. New discoveries are definitely rare. They're more expensive to bring online. And then on the monetary side, silver historically lags gold in the early stages of the cycle. So if silver were trading at multiples of its historical purchasing power relative to equities, which is kind of what this chart is laying out, then that could make sense. But by that metric, it's not even close. Silver has been much, much more volatile than gold. And I get the sense sometimes it's almost emotional. And for a lot of people, that can be frustrating. Calling it a bubble, though, at these levels says more about sort of the short-term price anchoring than it does about the longer-term valuation. I'm not endorsing silver here by any stretch of the imagination, but sometimes what looks expensive in nominal terms is actually cheap in a historical context. I'd love to hear from you. Are you buying silver? Are you buying any other precious metals? Speaking of precious metals, well, an episode wouldn't be complete without talking about gold. Here are some of the big calls for 2026, starting off with the top of the pack. So you've got the likes of JP Morgan and Goldman Sachs that see a breakthrough $5,000 an ounce. It's a reminder we're around $4,500 an ounce as we speak. with Venezuela playing out in full swing. Big question marks around the widening of geopolitical tensions in all corners of the globe. In the middle of the pack, you got the likes of Standard Chartered and Deutsche Bank. There are, of course, other factors at play. Central banks in emerging markets have been buying more gold, and China has been leading that front. And so the expectation is that is going to continue over this next 6 to 12 months and help propel the price of gold even higher. And then you have interest rates, which globally have been coming down. Those are stimulative. Those create a currency devaluation impact, and gold usually reprices a little bit off that basis. It'll be fascinating to see which of these analysts get it right, because we know in 2025, basically nobody got it right, and gold overshot most, if not all, of the projections. So whether we're going to get that again is really going to come down to whether these individual variables combined can take another leg higher in terms of escalation, which would be very dramatic. With all that being said, the survey of 11 analysts by the Financial Times forecasts gold increasing in price to $4,610 an ounce, which is a reminder, again, of how wide the spectrum is in terms of the calls for the remainder of the year. One more chart I want to zoom in on, and that is going to be of huge value to you, just getting a better grip on the calls for US stocks for the remainder of the year. And they've been compiled on this chart, and you've got the more conservative calls, right? So from the likes of Bank of America, Societe Generale, HSBC sees 7,500 points. And then on the much more bullish side, you've got Oppenheimer with the biggest call of 8,100 points. And the issue is not necessarily that you've got big calls. I love big calls, right? The issue is that there is a massive level of consensus that everything is going to go up. I don't see anybody saying anything is going to go down. And that's a bit of a warning sign, isn't it? Look, I get it. I've been following financial markets for over 20 years, and nobody wants to be an outlier when markets are strong. It's safer to be a little bit bullish, tweak a multiple here, assume earnings growth there, and just move on. And there is this benign narrative that inflation is going to cool, rates are going to drift without a growth shock, and earnings expand just enough to justify higher multiples. Okay, fine. Volatility stays contained. Policy risk remains manageable. But the key thing to remember here, it's never a perfect glide path. And you have to ask yourself, when was the last time the market followed a glide path for 12 months? That is what we need to talk about. So the risk is that these targets are wildly optimistic and they leave very little room for surprise. If growth disappoints, if inflation proves sticky, if geopolitics continue to escalate, financial conditions tighten, the margin for error is just so thin. And still, positioning trends are following the narratives. And so you've got these flows towards what feels like it's consensus safe, and big tech leadership gets extrapolated, index concentration deepens, trade becomes crowded, but the market as a whole is actually becoming more fragile. And that's another potent wake-up call in terms of potential diversification that needs to be done for a lot of these portfolios out there, away from concentration in US and particularly tech stocks. It reminds me of a note from BBVA just around the beginning of the year, and they said that 2026 will likely suffer from some AI altitude sickness, and they are rebalancing out of the crowded US IT plays and would only look to buy the dip in US IT on a sizable technical correction. And that's all we have for this edition of Money Ideas. What a way to start 2026 for global markets. As always, I'd love to hear from you and get your input. So drop a comment below or send us a message with any charts you'd like us to feature or flag. And until next time, thank you for watching.